So through the years, Warren Buffett has given countless indispensable advice to both new and experienced investors. But if we had to be selective and just pick 3 pieces of advice from this never-ending pile of wisdom, what would those 3 be? So here you have it, the 3 greatest tips and pieces of advice from the legendary icon that is Warren Buffett. And jumping right in and starting things off with a confusing point but is actually understandable, a stock is actually not a stock. Listen to this.
The first is that a stock is part of a business. I mean, you can't think of a stock as something different. It's you value a business and then you divide by the shares outstanding. But what you have to think about is what kind of a business are you getting into, what are its economic characteristics, who are its competitors, what's management like, all of these things that relate to a business instead of a little ticker symbol. I used to know when I was 11 or 12, the ticker symbols of every company virtually on the New York Stock Exchange. I could mark the boards, pairs up of, but I didn't know anything. I mean, I knew that X was U.S. Steel and T was the 𝐃𝐈𝐒𝐂𝐃 and so on, but I didn't know anything. I didn't know what was behind it. So I had to start looking at these little symbols or these little names in the paper as businesses and decide, how do you value a business? What counts?
So what Warren Buffett is saying here is a stock is actually not just 4 letters. It's not even a chart that you can trade off. It's actually a business with fundamentals, and the fundamentals actually matter. And when you look to buy a business, you should be looking as if you were buying the whole business and not just 4 letters and a chart on a screen. For example, if you see a stock falling, say 50, 60% on a chart, it doesn't mean that it's actually going to go back to them all-time highs and it's missed price. In fact, that rarely happens. Remember that stocks are in fact actual businesses, and businesses, well, they fail all the time. And further on this topic, Warren Buffett has arguably his most famous quote, and that is, rule number 1 is never lose money, and rule number 2, never forget rule number 1. And what he means by this quote and the clip from earlier is it's actually a lot harder to work from a losing position. So it's important that we pick the right businesses at the right time with the right fundamentals right from the get-go. Don't just buy a company because you see it's down 50% on a chart or you indeed like their product. And the way Warren gets around this and in turn limits his risk of buying a business that might not have the best fundamentals is valuing the business first before he even looks at the total value or in turn the stock price. This way, he completely stays impartial. Have a listen to this.
I sit there in my office and I read an annual report, which fortunately was in English, and it described a very good company and told about the oil reserves, told about the refining, told about the chemicals, everything else. And I sat there and read it, and I thought to myself, this company is worth about $100 billion. Now, I didn't look at the price first. I look at the business first and try and figure out what it's worth, because if I look at the price first, I'll get influenced by that. So I look at the company first. I try to value it, and then I look at the price, and if the price is way less than what I've just valued it at, I'm going to buy it.
So there you have it, the first piece of advice from the legendary investor Warren Buffett. Remember that a stock is not a stock, it's actually a business, and you're buying a business whenever you make a purchase. Do whatever you need to do to find the total value of what you would be willing to pay for this business before you go ahead and look at the capitalization or the total value of the business, or worst case, the stock price itself, because the stock price, if you're just finding this video and you've never started investing before, the stock price is completely irrelevant. Point number 2 is such a great quote. I have it written down in my diary and I read it every single day, and that is, if you go down to the pinned comment of this video and sign up with eToro via the links in that comment, you get a lifetime pass to the LWT eToro chat room. And while you're down there, make sure you have smashed the like button. Now, of course, I'm joking, but you do get a lifetime pass if you check out the links down on the pinned comment. But Warren Buffett's second greatest quote of all time is something that most investors seem to have missed over the last couple of years. Have a listen to this.
I would say that the most important thing over a long period and working with big money is to understand the business. Let's just say for the moment that you were given $1 million or whatever sum was necessary, and you could look around Knoxville or look around all of Tennessee if you want and buy into any 3 businesses, between now and a week from now, private businesses, not trading or anything of the sort. You got a week to do it or you have to give the money back. What will you be doing during the next week? You can look at all these companies. Some of them you're quite familiar with, some of them you're less familiar with, some of them you know by reputation, some of them you know the management, some of them you don't. You know their competitive situation. What will you be thinking about during that 7-day period? How will you actually be screening these companies out? I think you'll look for 3 businesses, and you can't trade them after you buy them. You're going to own them the rest of your life. You're going to be looking for businesses that have enduring competitive advantage. You don't want to buy a Burger King franchise just because nobody's come within 10 miles of it yet, because you know Wendy's and McDonald's and all of those will be there pretty soon. I mean, it isn't necessarily who's earning the most money now. You're going to look for something with enduring competitive advantage. Now, that takes a business with some kind of a moat around, because capitalism, by definition, is a system where every time somebody has an economic castle, somebody else is going to come after it. It's just the nature. If you open a restaurant that's successful here in town, you know, somebody's going to take your menu and probably take your chef, maybe cut your price, maybe offer a little more parking, maybe be a better okay, whatever. I mean, capitalism consists of going after the other guy's castle. If that's the case, you want a castle with a big moat around it. There's a lot of ways you can have a moat around something. You could have it by patent protection. You could have it by location in certain areas. I mean, if you have something in people's mind, like Coca-Cola, 6 billion people in the world, practically all of them have something in their mind about Coca-Cola, largely favorable. They don't have anything in their mind about RC Cola. And if RC Cola spent $1 billion advertising, they wouldn't have anything in their mind about RC Cola. They've got something in their mind about Coke, and generally it's favorable. That's why Coke wants to be where people are happy, because they want to be at the theater. They want to be at Disney World. They want to be at the World Series. They want always have you drinking that drink of Coca-Cola while at the same time experiencing happiness. And if they do that, they're going to sell a lot of Coca-Cola. And it won't make any difference if somebody is a half a cent less from serving Coke. So that's an enduring competitive advantage.
So what Warren is trying to get at here, and we'll elaborate on this point, is buy a business that you know, not think, that you know will stand the test of time. A great example here would be if you look at the last couple of years from like 2020 to 2021, the EV, the electrical vehicle craze that we've all been going through. If you're watching this video in 5 years' time, you'll see how that'll have played out. But right now, over the last couple of years, everybody's been scrambling to buy the next Tesla. And reality is most of these companies like Rivian, Lucid, Nikola, and so on and so forth, Lordstown Motors, had not even sold a car, and they had valuations more than companies selling millions and millions of cars. They were not an established business. And that's also relatable if you're a little bit older to what happened in the dot-com bubble. People simply bought the hype of the business and the potential future of the business rather than looking past the hype and looking at the solid numbers of said business. And what's more, they definitely didn't buy a business that has what Warren calls a moat. Rivian, I feel, is sort of the best example in this sector because it is a pickup truck company that has probably one of the best looking EVs I've ever seen. And people thought that was enough for this company to have such a lofty valuation until Ford caught up and actually released the Ford F-150 Lightning. And since then, well, and few other things and issues, Rivian sort of fell into the pits of hell, and still at the recording of this video is continuing to fall. Ford bringing out this truck basically killed off Rivian's chances of cornering the market of having the only EV pickup. In other words, its moat that Rivian had didn't exist. What Warren tries to do is he likes to find businesses that have no competitors or serious competitors in the market. He's very famous for buying Coca-Cola, and his thing in his whole thesis on Coca-Cola is when you buy and drink a Coca-Cola, it's usually at a cinema, at a bowling alley, at a bar, or somewhere where you're a little bit happy. And this then resonates with the human psyche, and a company like RC Cola has no chance of ever competing. Coca-Cola is so well established in the human lives of everyday Western people that it's basically going to be around at least till the end of my lifetime. So find a business that can withstand the test of time. It can have people undercutting it in price, maybe even a competitor with a better product, but find a company that will potentially stand the test of time. And this brings me on to what I feel is probably the greatest piece of advice Warren Buffett has ever given, albeit it's very, very underrated. The difference between successful people and really successful people is the really successful people say no to almost everything. You've got to keep control of your time, and you can't unless you say no. You can't let people set your agenda in life. Now, to me, this actually has a double meaning because you can apply it to everyday life, but also you can apply it to your investments. For example, if you just get a blank sheet company's papers, you look at the revenues and you can establish what the company or business should be valued at, which is what Warren Buffett actually does. Then you can go ahead and check what its current value is and see if it's simply undervalued or overvalued. And if it's overvalued or fair valued, you don't want to buy it. And saying no at this stage will save you a hell of a lot of time before you buy into the next Tesla or any company that has a great story. In the world we live in, companies can literally target you as a new investor because you've just typed in Google, how do I become a better investor? How do I open a brokerage account? And so on and so forth. So if you were a bad company that needed to raise money, you can advertise directly on Google to that person. And this in turn will infect your brain and convince you this is a good company. Humans are very, very biased on how they use their time. If you spend 10 hours researching anything to invest in, I guarantee you will convince yourself that this is a good business to buy into and that you think it's got a good future, because businesses will never paint themselves as the bad guys in any movie. A solid investor has to have the willingness to say no and move on quickly. And the second thing that I think saying no to is on your current position, meaning that if you're down on a big position and you're thinking, oh God, please let me get break even and I'll promise I'll sell, then maybe you should just sell it and move on. Listen to this quote. In the business world, the rearview mirror is always cleaner than the windshield. So if you have your money in a business and you think that you might have made the wrong decision, the business is slowly dying and you realize it, just go and sell it. Remember what rule number 1 is. Never lose money. And yes, you're going to be wrong. Even the best investors like Warren Buffett are only right like 60 to 70% of the time. Don't hold on to a business that you've now admitted is overvalued. Don't hold on to it, just sell and move on. Because that recovery you're hoping for might never come, because a new investor looking at the business may also think this is overvalued. If you're holding on to a stock and looking in that rearview mirror, hoping that one day it will become profitable, you're probably going to miss what's in the windshield, and that could be your next big opportunity. I hope that you've enjoyed this video. You've smashed the like button. If you want to hear more from Warren Buffett, check this video out up here and drop the code word down below, which is Warren Buffett. Thanks for watching. Take care.